Good morning, everyone. It's a pleasure to be here. Thank you for the invitation. And congratulations on organizing the fourth conference of beGLOBAL Be Success. My name is Htite. A lot of people know me by LendingClub. About 3 years ago, I moved to China and we started a similar business model as we did in the US in 2007. The purpose of my presentation today is to try to share with you our experiences in building the world's largest P2P platform in the US, as well as go into a new market in China. The two markets are very different from one another. So I composed this presentation in two parts. The first part is to talk about the business model, and the second part is to talk about the technology behind it. Why is it such a big thing? Last night, we were having dinner with some friends, and I asked people, what is the status of P2P in Korea, in South Korea? And they told me there is a lot of hype, but there is not a lot of substance yet. So I would like to share with you the substance that we believe we found inside of this business model. So the first point, why should you care? I think you should care because it's a global phenomenon. Internet finance is in the US, in Europe, in Africa, in Asia, it's everywhere. If you look at this map, which was put together by a partner in London, the size of all P2P in the US was 2.3 billion, and that was in 2013. Today alone, LendingClub is almost $10 billion in originations. Why you should care? Because it's not specific to any product. You can see that internet finance touches real estate, payday loans, student loans, car loans, regular loans, and soon credit cards and insurance products as well. So it's a big phenomenon. A lot of people think that a P2P is a loan product. If I'm unable to get a loan from a bank, I will go to a P2P company to get a loan. It's completely wrong. P2P is a way of operating the lending business. So what does that mean? In general, the way banks work is that people apply for credit, the bank does underwriting, and then they put everything together in a package. And they take that package to places like Wall Street through the process of securitizations, and they sell it to mutual funds or investors that sell it to people again, which means this person over here could be getting money from a person over there through a very complicated set of steps. So in 2007 and 2008, the process of securitization in tranches is what created the financial crisis, because nobody knew what was inside those packages. So we said, we want to remove that. That's not good. We want the bank to go directly to investors. Usually banks, twice a year or 3 times a year, they go on a roadshow to get capital from institutions. We said you don't have to do that. Capital can come to you every day because today investors are on the internet. But yes, an internet investor is going to invest 5,000, 10,000 RMB when an institution is going to invest $500 million. Not a problem, because if you have a lot of them, you get a lot of money. And if you use technology very well, you can get really a lot of them. So whether in the US or in China, we always have a problem of too many lenders and not enough good loans. You have the same problem in Korea. It's actually the world has the same problem. There is always too many lenders, not enough good quality borrowers. So today, banks are facing big challenges. The business of a bank is becoming more and more traditional and old. I'll explain to you what that means. When I was young, my father would take me to the bank, and the banker knew my name. He knew what my father was doing. My father owned a small business, and he knew how old I was. So the relationship between the banker and the customer was very, very close. But what happened in the last 10, 15 years is that people moved to using the internet, but the bank did not update to become an internet company. So that distance between the customer and the bank became very big, very large. And that void was filled up by third payment companies. So the way it works today is that a bank is happy and they say, oh, we have $17 billion from a company called Alipay or PayPal. But they don't know what people are using the money for. So they cannot anticipate what the future of finance is going to be. So banks are becoming infrastructure, not businesses. So the same way the electricity company or the road company. So when we get electricity today, the electricity company does not know whether we're using it to power TVs or computers. The same way, the bank today uses money, has money, but they don't know if people are using it for student loans or for entrepreneurship projects or for just spending it. The payment company knows because the payment company is so close to the customer. So that is the biggest problem of the bank. The bank is becoming more and more decoupled from the customer. But it's not over yet. We believe that internet finance is not a disruption to the bank. We do not want to disrupt the bank, but we want to help transform the banks. What is the value of a bank? The value of a bank is the trust we gave them. So one big problem is, how do I know that you are a good borrower versus you who is a bad borrower? That responsibility is the main reason why we have banks. That's their job. So the model that we're proposing, the model that we proposed for the last 8 years, is the marketplace concept. What is a marketplace concept? Is, again, if you put two sides, you have people that need money versus people that want money. Which one do I give money to? Then we do underwriting. We do underwriting and pricing. Nobody in the world today knows how to do that better than the bank. But once it's done, the bank does not have to worry about where the money is coming from because we created an exchange market for them. See, the same way Goldman Sachs and UBS, they take companies IPO, they don't invest in them. They just underwrite them and they value them and then they put them in the stock market. We ask banks to take borrowers, underwrite them, and put them in the loan markets. So the bank will never have asset liability management. That's the concept that we introduced. And it's been working very well. So if you look deeper, on one side you have a borrower, on the other side you have an investor. The lender gives money to the borrower makes payments, whether the payments are monthly or daily or weekly, whatever. Immediately after the payment is made, it goes to the investor. Platforms like ours do not participate in the transaction. We do not do arbitrage. We don't take money at a lower price to lend it at a higher price. We are completely outside of the transaction because we need to be transparent, because we need to respect some rules. So we get a fee, a commission fee for operating the platform. We say we get a fee from the borrower because we helped him find capital, and we get a fee from the lender because we helped him make returns. And if they don't make returns, they don't have to pay. It's actually, the LendingClub service fee is very, very fair. We only charge you if you make money. And if the borrower is late and does not pay, he has to pay late fees. Those late fees don't come to us. They go directly to the lender because it's the lender who took the risk. That relationship between us and our customer is very, very clear. And that's what defines the concept of marketplace versus a financial institution. So if you build an exchange market, you can think of it as a small exchange market that is private. For example, in China, there are 365 banks. China is a very large country. One of the banks that we helped is offering that service to the people around the region of Suzhou. But you can also think of a public market for all of China, maybe for all of Asia. So the power of the internet is the ability to distribute. So one day in the future, I hope that we're going to see a small business in Shanghai or in Seoul getting money from a lender in Australia or in Singapore or in the US or next door. It doesn't matter. The internet will make everybody close to each other. What's important is that if you're starting a business today and you need a loan and only 100 people can see you, the price that you're going to get is always going to be high. If I give you 1,000 more people, they're going to lower the price on you. If I give you $1 million or $100 million, you will get a better deal. And that's what we try to do. We look at internet finance as a logistics problem. How do we connect people very efficiently as often as possible? So we started this business in 2007 when we created the company. If you can see from over there, the 2007, 2008, we have this much business, very little business. But then suddenly, the awareness started growing. Then in 2012, we hit $1 billion in origination, which was a big amount for us at that time. And immediately after that, we moved from 1 billion to 5 billion. Today, we do, at LendingClub, we do 1.6 billion each quarter. We are almost at 10 billion. But what's interesting is that we are serving more than 350,000 borrowers. Not many banks in the US can serve more than 25,000 borrowers. We have 350,000 borrowers. That should show you how good we are in using technology to scale. This is a volume business. The more people participate in this market, the better everybody gains. In China, our growth is even faster. In the US, we were growing 10% month over month. In China, we are growing 25% month over month. Why? It's because in the US, we have a very, very established financial services. Everything is automated already. So when we came in, we moved the industry from this level to that level. In China, there is absolutely nothing. So we're moving the industry from almost nothing to a very modern level. That's why we see a lot of people coming in. A lot of people will tell you, if you ask how many P2P companies are in China, some will answer 2,000, 3,000 P2P companies. How many P2P companies are in France? Some people will say 70 companies or 100 companies. There is a very, very different definition of P2P that we understand versus other people. So I put the two models side by side. So on the right-hand side are people that are using the internet, but what they do, they start first by finding the lenders, and they sell an investment product. And then they look for borrowers. So they are taking a risk. They are taking the arbitrage risk. Real P2P, or what we call today pure P2P, is making sure that the borrower is what comes first. We should not, as a platform, we should not decide for your money, where does it go? You have the control and the authority. You like to invest in these kind of people, you invest in this kind of people. We don't promise that everybody that applies and is approved, that he's going to get a loan. That decision is with the lenders. So the right-hand side is not P2P. The right-hand side is illegal banking. The left-hand side is the concept of an exchange market. If the borrower pays 40% high risk, you will see him directly. If the borrower is low risk and pays 7%, you choose to invest in that. Very different concept. So of course, all of this is great. But why is it that we are only seeing it today? We are only seeing it today because the technology to operate such a thing is very complicated. In the next slides, I will explain to you why it is complicated. First, let's compare it to banking technology. So banking technology is what we call one-to-many. So I spent a long time in Oracle building technology for banks. The idea is there is one control center. I am the chief risk officer. I decide that the money is going to go to this type of product, this type of product, this type of product. But for a bank to move money between customers, it's actually very expensive. That's why there is no bank in the world that is very successful in doing third payment companies. Whether you're in the US again or in China, third payment companies are created by internet companies. Why? Because we understand very well the concept of many-to-many. Banks love accounts. We love transactions. We love very, 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 very small transactions. So fundamentally, that's a big difference. We have to learn, we have to create systems how to deal with millions and millions of transactions. And that is exactly what we created. At LendingClub or at Dianrong in China, we created what we call a super large processing machine. So if every month we generate 100 to 150 million transactions, and I've been doing this month after month after month after month, after 10 years, you come and you tell me, why is my balance $14? I should go in less than 1 second, go through all these transactions, which could be a huge number, and itemize everything for you. That is the core of the technology behind it. And unless you have technology like this, you can never scale the business. And if you cannot scale the business, you will never be as big as the New York Stock Exchange or the NASDAQ or any stock market that makes sense. Because the revenue we make is very small. So let me tell you how we use this powerful technology. So for example, today, if you are a restaurant in Shanghai, small business, and you want to borrow money, you go to a bank, the bank is going to charge you 24% plus 5% for fee. So your cost is about 30%. It's not making sense for a business. It's too high. And of course, if you charge people a high interest rate, they will default because they cannot pay. So we give that customer the same loan, exact same loan, for 12%. With one condition, is that he makes daily payments. It does not mean that we play with the interest rates and the APR. No, it's really 12%. So why is that important? It's important because when we get the first payments, we put it in another loan, and another loan, and another loan, and another loan, and another loan. Because we are not scared of creating too many transactions. So if you borrow from us from 1 year, we will have 365 transactions. With the bank, there are only 12 transactions. So think about it in a different way. If I am the small business, what do I do? For 29 days, I'm collecting money, and then at the end, I pay my loan. So for 29 days, money is sitting doing absolutely nothing. And that is bad for everyone. So we told you to move it quickly. And in lending, there is a number that we call money utilization. So if you're lending at people at 12%, it's almost like if you're lending at 30% from a money utilization point of view. So let's say this is our society today. Let's say with the banking model, in order to create a small business environment, we need to ask the government to give us $1 billion. With 1/3 of that, we can do much more because we move money between people so fast. So you need it for 6 months, you get it, but every day you're paying back. Whenever you pay, we give it to another person. And that's what I mean by technology people look to the world as a logistics problem. Finance people look at arbitrage game. So this is internet finance. That's what we do. It's not connecting people using the internet. We don't stop at that. So to summarize what we did, the combination of technology and the business model allows us to reduce the cost tremendously. And if you look at our numbers, a big part is the saving. And that saving, we don't put it back in our pocket. We actually split it again between the borrowers and the lenders. So the lenders will make higher yields, and the borrowers will continue paying lower interest rates. And that's how you create efficiency. Of course, we use big data, we use mobile technology, we use everything, but it's not at the core. These are tools that we use the same way Bank of China is using it, Bank of Korea is using it, everybody else is using it. Whenever there is a breakthrough, we use it as well. Mobile is extremely important, especially for people that are not banked already. Because more and more people are asking for loans, but they don't have a history. The world has changed. Before, only people that come from rich families can start a business because their parents trust them and they give them capital. Today, the new entrepreneur will have to look for capital. But if I show up and I don't have any data behind me, and I ask, oh, can I borrow 1 million because I want to do this and this and this with it? Most of the people don't know who I am. But today, because people are so attached to their mobiles, there is a lot of data we can get from it. I can prove to you that physically, I've been in Seoul between the 13th of May to the 16th of May, because my phone has the GPS location. If I tell you that this is my address and I take a picture of it, and I'm in my living room, you know that the picture was taken in that GPS location. There's a lot of data. I mean, yes, at the same time, we are losing on privacy, but it's a choice. It's a choice every society, every regulator has to make. To finish my presentation, I would like to give you an example. So this example is actually not a product. This is just an imaginary example to explain to you how we think about solving finance versus how banks think about solving finance. So imagine there is a company that has 100,000 people. Samsung, for example, or more. There is a CEO, there is an exec team. They have been working for 15, 20 years, so their financial situation is better. The people that just started, they are just starting their lives. They need to spend more before they get to that level. So banks will look at a company like Samsung and they will say, oh, that's 200,000 people. Let me create a credit card that says for Samsung employees, and I will give them a lower fee. So again, it could be that that person that is junior is borrowing money from the money that the exec team did put in, which does not make sense. So what we did is to look at companies in a different way. Oh, you're old. Perhaps you have more money, but that manager is getting married, and that one is buying a car, that one is going to school, that one is doing, that one is doing, that one is doing. So how about we create a marketplace for you inside your company? You have all the data you need about people. You know how much everybody is making. You have their identity verified. You know which school they went to because you hired them. And they need money. But other people are looking for investment product. How about we create this for you? That is exactly the example we did with Google in the US. With Google, in Silicon Valley, companies like Google, Facebook, Apple, they always fight over students coming out of Harvard, MIT, and these good schools. So in the US, these people, which are the core of the future economy, they have to pay loans, student loans, like $300,000, 6-7%. It's huge. So Google tells them, oh, if you join Google, you only have to pay 3%. So it's a hiring tool for Google. But Google can do it once, twice, 3 times, 4 times, 5 times. They cannot do it 100,000 times. So they use a platform like LendingClub to facilitate that. So our role in internet finance is to be an operator. You are the lender. You choose which borrowers you want. But you cannot do it alone. You cannot do it alone because if you do it alone, you're going to fail. You can only lend money to a small number of people. Your cost is going to be higher and higher and higher. If you use a platform like ours, you can lend to hundreds and thousands of people, and you diversify. And diversification is the best risk management tool to ever exist. And with that, I finish my presentation. Thank you.